course, yeah. So the backdrop itself, as we just discussed, was already quite bearish. But on top of that, you have the prospect. I mean, it's now a base case that Trump is putting tariffs on China during the first quarter, and that there are some funding pressures, some budget issues in the US, which mean that the prospect of using tariffs to fund some kind of reduction in the budget deficit, or at least not growth in the budget, is going to potentially hang over the market. So tariffs related to that is going to be an issue in 2025. And more broadly, I think Trump overall, if not eventually, is going to be quite net bearish for oil. So a lot of the statements that he said have been about how he wants to encourage drilling in the US, or at least Besant has talked about 3 million barrels more supply growth over the term in the US. You've got talk about stopping wars, not starting them. And we've done a lot of work in this annual outlook looking at the impact of what could happen if there's significant geopolitical de-escalations, both in the Middle East and across Russia, Ukraine. It would essentially free up a lot of oil that's currently in transit logistically, and it would loosen or at least increase the visible inventories, we think, and loosen some of the balance impacts on the market.
I wonder what's the biggest risk here when you think about your expectations for 2025, because when you think about conversations we've had in terms of tariffs, a lot of economists suggest, we need to wait and see what's the detail of these Trump tariffs to understand what's the economic impact. And ultimately, I'm asking the same when you think about whether he's actually going to be a bear for energy prices going forward. Could that be the biggest risk for 2025 if Trump doesn't deliver on some of these promises?
Yeah, I think overall in the base case, for example, we have Trump delivering directionally on most of his promises, but not fully in terms of the kind of rhetoric or the pledge. Certainly not in the first year. So directionally, some more tariffs. Directionally, some de-escalation, either in the Middle East or with Russia, Ukraine, but not necessarily in both. And certainly, for example, we don't have Iran continuing to produce at full capacity for the next 6 to 12 months. We are assuming some impact. We're going to lose 300,000 barrels for the first couple of quarters of next year in the base case. But even with that, overall, it's still directionally net bearish for oil.
Right. Let's talk about other commodities here.
Yeah.
I'm particularly fascinated by the gold performance this year. We're looking at very strong numbers. I just wonder whether this is likely to continue going into 2025.
Yeah. I mean, it's been a spectacular year for gold, right? I mean, you zoom out on a 50-year chart and you can see this bull market. And that's usually a sign there's been quite a significant bull market. Look, we're expecting it to continue. And, there's a couple of reasons. One is that we've introduced a fundamental physical flows-based framework for gold pricing, which gives us some confidence that the underlying drivers of this bull market, which has been investment from central banks, but also investment from wealthy OTC investors and investors more generally who are concerned about high interest rates in the US, high debt levels in the US. I mean, there's any number of concerns that people have, higher equity valuations. So, you've got people buying gold as a hedge against the medium-term impact of a US slowdown. I mean, the US has been slowing down for 2.5 years now. Labour market's been slowing down for 2.5 years. Real interest rates are still around 15-year highs. So people are concerned about some of these things. So until those things go away, there's going to be a lot of gold investment buying as a hedge. And obviously the central bank buying is for, pretty structural reasons that aren't going away anytime soon 100%. As well.